Countdown is on to the final Fed decision of 2019, and the central bank widely expected to keep rates on hold. Steve Liesman joins us now with what markets should expect later.
Morning, Andrew. With the Fed meeting just days after that blowout jobs report, normally the market will be thinking about, well, when and how much are they going to hike? As in, that's right, how much would they hike today? But not in the new normal times we live in. Instead, the Fed expected to remain on hold, and the question is, how long is that hold going to last, and which way will the Fed next move? And part of that comes from the very high bar that Fed Chairman Jay Powell set at the last press conference for any kind of interest rate hike.
I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns.
So what would it take for the Fed to move? Let's take a look. Well, a material change in the outlook is words that Powell has used before. In other words, inflation or growth coming in much different from how the Fed expected. A trade deal, perhaps, although some economists think whatever impact the trade wars have had is already sort of baked in, at least for the first half of 2020. And then, of course, a change in the global economic growth, weakness or strength either way, and their interest rates. Christine Lagarde taking the helm tomorrow at her first ECB meeting. What the Fed may have learned, guys, is that its real policy rate, that's adjusting it for inflation, it just needs to be negative in the times we live in to achieve potential growth. Take a look here. Go back to the end of the 1991 recession. The real Fed funds rate has been negative 55% of the time. This century, 71% of the time. So a negative real funds rate is the normal. Fed got slapped around by markets and the president, and it's now a aborted attempt to push rates into positive territory, what we all thought used to be normal. It's not a mistake it's going to make again anytime soon, so look for the Fed to be on hold for several months. And I think, Becky, what I'm hearing is that is positive for risk in this market.
Hey, Steve, I've seen a few people speculating that the reason the jobs number was so strong is because there's a lot of temporary work that's there for the holidays. Does that theory hold any water with you?
No, well, unless what you're saying is the government did not adjust correctly for the expected push in temporary work.
Are there more temporary workers than normal? I don't know.
Yeah, if that's true, that's good. But let me just tell you, that's what the term seasonal. And I think, hey, it is the season for seasonal adjustment. The data expects a massive influx of workers in December. It seasonally adjusts that out. Just like it expects these people to leave their jobs in January, they seasonally adjust that out. That's how we get 100, 200,000. I've said this 100 times, Becky, as you know. We may be up 1 million or down 1 million, but the way the seasonals put it is they smooth that out, up 100,000 or up, in this case, 266,000. It may be that there's more temporary workers. If that's true, then that's a good sign for expectations of retailers for holiday shopping.
But the short answer is no. Yeah.